All right, cousin. So from the state employee credit union, the product that you want to ask for is the share secured loan. Let me repeat that. Share secured loan. This stuck out like a sore thumb when I seen it because anything that says secured is really a it's pretty much a guarantee. And I don't want to say guarantee, but your odds are really high. And the reason why your odds are high is because, like I said in the video about secure credit cards, they don't really have that much risk. So the only difference between a secure credit card and a secured loan is that one is a credit card and one is a loan. That's really the only difference. One, you put your $1,000 up and they give you $1,000 credit card, and the other one, you put your $1,000 up and they give you $1,000 personal loan with a new account, right? So what you'll see is, let's say you have $1,000 in your savings account. They'll take the $1,000 from your savings account, and you'll see it'll be minus 1,000, and then they will give you a share secure loan account. In this case, other financial institutions may call it something different depending on the loan product. And then you will see that in that account, you have $1,000 that you can withdraw, right? So basically, they're just taking your money from one account and putting it in another account. The only difference is every month, you're going to have a minimum payment as if you actually were loaned the money, right? Even though it's your money, every month you're going to have a minimum payment you got to pay. Now, here's the thing. Let's just use $1,000 for example. There's a 5% interest rate. Now, 5% on $1,000 is $50. That's no money, right? To borrow $1,000, they're going to charge you $50 interest over the course of a year. Now, if you take the 12 months divided by $50, that's $6 a month. So you're paying $6 a month in interest. And from your $1,000, you're going to pay maybe like $83 a month, something like that, right? 800, 16, yeah, probably like $83 a month. So you're going to pay basically $90 a month. Every month, you're going to have a $90 payment. Now, here's the thing. When you pay your $90, what is going to take place is they're going to take their $6 in interest, and then the other $84, they're going to put back into your savings account, right? So realistically, you're just paying the money to have it put back in your savings account. And at the end of the year, instead of having $1,000 in your savings account, you're going to have 950. But that's cool because your credit score is going to go up, right? You're now going to prove the lenders that you are what? Credit worthy, because you're going to have a loan that shows up on your account that you paid off, right? You borrowed money and you paid it off. So I would suggest that you do the share secure loan. I do think that you should call before you apply for the loan and just ask these few questions. And really, all of the questions are going to be dependent upon one thing. And the first question you want to ask is, will there be a hard inquiry for this application? So basically what you want to know is this going to affect your credit score in terms of hard inquiries? Now, if you watch my other video about hard inquiries and why they're important, in terms of, it may be looking like you broke and you desperate, go check that out if you haven't checked it out. But basically what it boils down to is a hard inquiry can actually lower your credit score. You don't want to lower your credit score. You want to actually build your credit score up, right? So you want to know if there's a hard inquiry. From my experiences, when you're dealing with secure products, there isn't any type of credit check. That's the reason why they want you to put your money up to back the money that they're going to give you in return, right? So, but we still got to ask the question just in case, because most financial institutions don't run your credit doesn't mean all financial institutions don't run your credit, right? So that's the first question I want you to ask. If the answer is no, you ain't really got nothing else to pretty much ask for it, I guess you could skip to the last question, but for the most part, if the answer is yes, what I want you to ask next is, what credit bureau do you pull from? What credit bureau will you be using to determine whether or not I qualify for this loan? That's only if, when you ask, do you use hard inquiries, or will this be a hard inquiry, right? After you ask the question, will this be a hard inquiry? And they say yes, you then say, well, which credit bureau will you pull from? Which credit union will you be using to determine if I qualify, right? And after you ask that question, then you say, what are the qualifications credit-wise in order for me to obtain this product? And basically what you're asking is like, what does my credit score need to be? Do I need to have a certain amount of credit history in terms of age, right? My credit age, do I need a certain payment? These are the questions you basically ask. Well, you're basically asking those questions by asking, what do I need? What requirements are there for me to qualify for this product? But for the most part, I think like once you ask, is this a hard inquiry? Does this product come with a hard inquiry? Will there be a hard inquiry? Once they say no, you pretty much, you good. You could just proceed with filling out the application. At that point, similar to the secure credit card, I would say put as much money down as you can. So if you got $5,000, it's going to cost you $250. Don't even worry about that. Like I said, that's no money. You're going to pay $30 a month in interest. That's no money. But you're going to now have a $5,000 loan on your credit, and it's going to look like to lenders that you are actually, you know, turning the tide. You are building up. So that's what I would suggest. I would suggest with the state employee credit union, the first thing y'all want to do is y'all want to get a secure loan. Secure loan, because after we get the secure loan, right, then we're going to start asking questions about the unsecured loan, right? That straight personal loan, right? Yeah, that's what we're going to ask, because now we're going to take off $5,000 and we're going to turn our $5,000 into $10,000 by borrowing $5,000 from them, because we have proven that we are, yes, we are responsible individuals now, right? We wasn't before, but we are now. Another question that I would ask, because I didn't see it on the website, but also ask if they got a secure credit card. Say, hey, I see you got the Share Secure loan. Do you have any more products that are secure? Do you have any more credit building products? So ask that question as well. And pretty much after that, you should be good, man. Put your money up, put your $5,000, $2,000 up. Make that, like I said, that $90 payment a month. If it's $1,000, if you borrow $5,000, it's going to be $450 a month. And like I said, basically what you do is when you pay, they're going to take the money from the account that is personal, and then they're just going to put it back into your savings account, and you're going to be good to go. So that was my first suggestion. Once we cross that, you know, T and dot that I, I'm going to have some other sauce on it for you, and I'm going to tell you what to do next. But that's the first step to do.